As 2025 unfolds, whispers of an impending economic storm are becoming increasingly hard to ignore. Experts are sounding alarms, indicators are flashing red, and ordinary citizens are beginning to feel unease at kitchen tables nationwide. Could the US economy be spiraling towards another recession? If so, what exactly will trigger this downturn, and what impact might it have on our daily lives? In early 2025, President Trump's sweeping tariffs sent shockwaves through the global economy. Initially announced as a protective measure, these tariffs have morphed into a complex web of economic strain. A blanket 10% tariff across the board was enough to raise eyebrows, but additional duties reaching as high as 50% on crucial trading partners like China, India, and the European Union have amplified concerns. Economists fear these tariffs will ripple throughout the US economy, hitting consumer wallets first. As imported goods become more expensive, everyday items from smartphones to shoes may soon feel out of reach for many families. Manufacturers relying on imported components will inevitably face escalating costs, potentially leading to reduced production, layoffs, and ultimately diminished economic growth. But tariffs aren't the sole storm clouds gathering overhead. Inflation, a persistent thorn in the side of economic stability, is back with a vengeance. After spiking to a dizzying 9.1% in 2023, inflation seemed to recede, offering a brief respite. However, recent data shows an unexpected resurgence, with the Consumer Price Index stubbornly hovering above 4.2%. This isn't just numbers on a page. It's food prices soaring, housing becoming unaffordable, and families forced to choose between saving and survival. Historically, high inflation erodes consumer purchasing power. When wages lag behind price increases, families must either tighten their belts, dip into savings, or sink deeper into debt. Each choice, however temporary, contributes to an economic slowdown as demand falls and businesses scale back production. This downward spiral feeds on itself, making recovery increasingly difficult. Compounding this economic headache are the Federal Reserve's aggressive interest rate hikes. Designed to combat inflation, these measures come at a high cost. The federal funds rate currently stands at an imposing 4.34%, marking nearly 30 months of continuous tightening, the longest sustained period of restrictive monetary policy in recent history. Historically, such prolonged tightening has reliably signaled recessions, occurring in 7 of the last 9 downturns since 1960. High interest rates squeeze both businesses and consumers. Companies face higher borrowing costs, curtailing expansion plans and new hiring. Consumers feel the pinch most acutely in housing markets, where rising mortgage rates translate directly into reduced affordability. Consequently, the real estate market, often the first domino to fall in economic downturns, is already showing troubling signs of weakness. Globally, economic conditions offer no solace. The interconnectedness of modern economies means trouble abroad inevitably spills onto American shores. The International Monetary Fund has revised global growth projections downward repeatedly over the last 9 months. Particularly troubling is China's manufacturing slowdown, now contracting for 4 straight quarters. With China accounting for 15% of US imports, vulnerabilities within American supply chains have grown acute. This international slowdown could trigger financial instability domestically. Commercial real estate presents an alarming vulnerability. Office vacancy rates have surged above 19% nationwide, and property valuations in key markets have plummeted by 25 to 40%. An eye-watering $1.2 trillion worth of commercial mortgages are due for refinancing within the next 2 years, under significantly less favorable terms. The ghosts of the 2023 banking crisis, which saw the collapse of institutions like Silicon Valley Bank, still haunt regional banks deeply tied to commercial property. If these conditions coalesce into a full-blown recession, the consequences would be severe and widespread. Job losses would rise sharply, hitting vulnerable sectors hardest: construction workers, retail employees, hospitality staff, and manufacturers would bear the brunt first. The Congressional Budget Office warns unemployment could spike from its current 4.2% to nearly 7.5%, a devastating scenario involving up to 5 million Americans losing their livelihoods. Corporate profits would undoubtedly plummet. Historically, recessions have slashed S&P 500 earnings by 15 to 25%. Small businesses, often operating on thin margins and tighter credit conditions, would face an even harsher reality, amplifying job losses and deepening economic distress. Stock markets, sensitive barometers of economic health, would likely experience severe corrections, erasing trillions in household wealth almost overnight. Such losses aren't just abstract figures. They translate directly into reduced spending, cancelled vacations, delayed retirements, and shelved dreams for countless families. Meanwhile, the government's fiscal health would deteriorate rapidly. Tax revenues shrink during recessions, just as demands on safety net programs, unemployment insurance, food assistance, healthcare subsidies increase dramatically. Compounding this challenge, recent budget cuts by the Trump administration have weakened or eliminated several vital programs, potentially leaving millions without adequate support. Experts closely monitoring economic indicators see a disturbing alignment of factors that have historically predicted recessions. GDP growth has slowed alarmingly, registering a mere 1.1% in early 2025, less than half the long-term average. Strikingly, consumer spending has contributed minimal growth, masked only by government expenditures propping up the numbers. Employment indicators, traditionally lagging but critical confirmation signs of recession, show troubling trends. Initial jobless claims have steadily risen, averaging 285,000 weekly, significantly higher than a year ago. Temporary employment, often a reliable early warning indicator, has declined consistently over 9 months, highlighting growing instability in the labor market. Perhaps the most ominous warning comes from the bond market. The yield curve inversion, where short-term interest rates surpass long-term rates, has persisted since mid-2022, marking the longest inversion period in modern economic history. Such inversions have reliably predicted recessions with over 94% accuracy since 1955. Consumer confidence has also plummeted, signaling growing anxiety. The Conference Board's Consumer Confidence Index has fallen for 5 consecutive months, slipping to a worrying 92.6, far below its long-term average and nearing levels historically associated with recessions. Retail sales, particularly in discretionary sectors like furniture and electronics, have weakened significantly, suggesting households are already feeling financially stretched. Leading economists have amplified their warnings. A recent Wall Street Journal survey found economists increasingly pessimistic, now assigning a 65% likelihood of recession by year-end, a stark increase from just 6 months prior. Nouriel Roubini, famously predicting the 2008 crash, warns that the current landscape resembles a perfect storm, combining persistent inflation, restrictive monetary policy, and geopolitical tensions. He places the recession probability at a troubling 80% by late 2025. Larry Summers, former Treasury Secretary, echoes this sentiment, highlighting household debt service payments at their highest level since 2007. This burden, combined with deteriorating housing affordability, mirrors conditions preceding severe recessions in the past. In anticipation, consumers and investors are urged to prepare defensively. Establishing robust emergency funds covering 6 to 9 months of essential expenses becomes crucial. Historically, job searches during recessions take considerably longer, and unemployment benefits typically replace less than half of lost income. Investment strategies must pivot towards defensive sectors such as healthcare, utilities, and consumer staples. Historically, these areas fare better during downturns, providing relative stability amid broader market turmoil. Households should prioritize debt reduction, especially high-interest, variable-rate obligations that become significantly more burdensome in tough economic climates. For businesses, proactively managing balance sheets, extending debt maturities, and securing credit lines before financial conditions worsen becomes imperative. Such measures can spell the difference between surviving or succumbing to economic headwinds. As the second half of 2025 approaches, economic turbulence seems increasingly inevitable. By understanding the signs, anticipating the impact, and proactively preparing, Americans can weather the storm more effectively. But ignoring these warnings risks severe economic pain for families, businesses, and the nation itself. In the end, 2025 stands poised on the brink. Whether we plunge into recession or navigate through unscathed will largely depend on how quickly and effectively we heed these critical warnings.